All topics covered here are for conversational purposes only and do not constitute financial advice. Please contact us for advice on all matters discussed here from one of our professionals. Welcome back, listeners, to the next episode of the FS360 podcast. Financial Security 360 is what we're all about here at M Group. And today I've got one of our newest members of our partner group, Liam Nankervis. Welcome, Liam.
Thanks, Gav. Good to be here.
Thank you. Nice to have you on, mate. We are sitting here today in the sunny Geelong office. And Liam, congratulations on becoming a partner in the lending division.
Thank you. It's a privilege for one. It comes with its workload too, but yeah, really good to be recognised and then become a part of the broader business, not just for the responsibility and what it means for our clients, but also the future of the business as well with M Group, which I'm really excited about.
And it is an exciting time, isn't it? I know Geelong office, you guys are looking at moving office shortly. We're saying 2026.
It's really exciting. It's going to be one of the best buildings in Geelong, down in Newtown on the Barwon River. And we're probably going to say within 3 months of finishing construction, but then we've got to get the fit out done and move on over. So it's not far.
Not far. Yeah. No, that's going to move pretty quick. Well, we're already in March. So that looks amazing. Even some of the photos that you guys have been sending through and even the artist impressions and the floor plans, it looks amazing. Yeah. Importantly, I know Warren's been big on this. He's really keen that the office is a real feature of a place to come for clients too. You know, there'll be some really good end of trip facilities for clients. There'll be a cafe there and all those things. So I think it'll be a place that clients want to come.
Yeah, absolutely. And staff too, just having a beautiful place to come to work, especially where it's going to be located. And it's going to be much more vibrant than the current office space because, one, it's a new building, but it's going to be 3 sides of glass where we can have plenty of sunlight come in, and there's going to be a lot of nice things to look at outside. Yeah, hopefully not too much of a distraction.
No. And I think these days, I think environment is so important for your staff as well, isn't it? Like if you love where you work, it's just so much more fun to come to work every day. And I think talking to Warren and Jamie and Scott about it as well, there's going to be some end-of-trip facilities, so there's going to be some showers and things like that. It's pretty good solar-wise and energy-wise, the whole new building. So, really, really, it's a sort of a stake in the ground for M Group in Geelong.
Oh, it's huge. Yeah, I'm really excited about it, and we've been excited about it for over 12 months. So it's nice that it's getting a lot closer. Yeah, perfect. Yeah, really looking forward to getting there. Yeah,
nice one. Well, welcome to the business as such. You've been a broker here for a number of years, but becoming a partner in the business is big news. So congratulations
Thank
again.
you.
Thanks, Liam. Well, today we're going to talk about some lending matters, about home loans. You guys are obviously mortgage brokers here. The first one you wanted to talk about was the Australian Government 5% deposit scheme. So this is pretty big news. I've listened to a few podcasts on it. I've even had a family member, a nephew, sort of undertake the 5% deposit scheme. So tell us a little bit about it, just in your words, to help our clients understand.
Well, this has been through a couple of iterations since 2020, how it's been change of name from the first home loan deposit scheme through to the first home guarantee, and now they're labelling it the 5% deposit scheme. So there's no confusion about how much money you need to be putting in. But what we're looking at is
put 5% in the name.
Nice and easy. Exactly. So there's some different criteria that's evolved over time as well. But since 2020, the federal government have come in and said, we're going to help first home buyers to get back into the property market. And we're going to do that with a minimum 5% deposit. So what it means is that we need to borrow up to 95% of the value of the property. You do need to cover your purchase costs as well. So this is where a little bit of confusion can come around.
You're talking about conveyancing, legals, all that sort of stuff.
And even things like stamp duty, mortgage registrations. So some real government fees that get tacked onto the price. But depending on how much you purchase for, whether there's any stamp duty related to your property, you might be putting in your 5% and then needing to cover that on top as well. So it can be a little bit misleading in a sense.
It's not 5%
it's not
gross,
strictly,
it's probably 5% net. It's sort of like part of.
Yeah, it's just the 5% of the purchase price, property price, and then you cover your other costs on top of that as well.
Yep.
So the federal government have come in and said, we'll make it easier and get you a better loan so you can get into the property market easier. You are being guaranteed by the federal government, and you don't pay any lender's mortgage insurance on
That's
your
the big
home
one,
loan.
isn't it?
Yeah.
LMI, it's often called in the industry, but lender's mortgage insurance, can you run us through the history of what that is? Because I think a lot of people don't, if you've never been through a home loan, and probably today we're specifically talking to first home buyers here. If you don't know what that is, it's all around sort of guaranteeing that you can pay that home loan back, and you have to take out basically an insurance policy if you're below the 20% deposit.
Yeah, absolutely. So I suppose the biggest difference between having this scheme where you avoid these costs as opposed to not having the scheme like we did prior to 2020 when it was introduced is that you would have the lender take out an insurance premium for lending you the money on a smaller deposit, therefore it's a riskier transaction. So in the event that you might actually default on your mortgage and they can't repay all of the debt, they need an insurer to help cover the rest of the debt, and then maybe that insurer would probably come for you to cover their losses if there were any. But the bank would take out the insurance premium, add it on top of your loan. So not only are you just paying maybe $10,000 to $30,000 in this LMI, you're also paying the interest on top of that you've added into your loan. And then you are getting a higher interest rate as well compared to what someone with a 20% deposit or under the 5% deposit scheme would normally get, making your repayments even more difficult and then potentially setting you up to fail in the future.
Oh, I didn't know about the higher interest rate. Yeah, that's interesting. Yeah, because they're seeing you as a high risk, so I suppose. So they don't give you the best rate. They give you the rate that they give you, I suppose.
And one of the things that a lot of people misunderstand is that it's there to protect them as a borrower. It's not. It's to protect the lender from their investment of giving you the money.
Yep.
So in the event that you default, you've paid for this insurance premium. There's no refunding of this insurance premium when you build up your equity or refinance your home loan. There are some exceptions to that if you do something within a 12-month window where you might get a small refund on your LMI premium that you paid, but it's pretty rare to come across. It'd be a very exceptional circumstance. But this LMI is just there to protect the lender. It's not there to protect the borrower, and really it's just an additional cost.
Paying for it.
Yeah, correct. It's just an additional cost that if you can avoid it, you should.
Yes. Yeah. And so the idea has always been save up your 20%, make sure you got your 20% before you even come to a mortgage broker. But 20% these days, Liam's a lot of money, isn't it? Like if a house is worth $500,000, 20%'s $100,000.
Well, if you're going for a family home in Geelong, you're probably talking about $700,000. I'm sure that is going to change all throughout the state of Victoria or wherever we're located around Australia. But if we're talking about where we operate here in Geelong, it's a very significant deposit. Yeah. If it was $700,000, we're looking at a $140,000 deposit. And then, as I alluded to before, there might be the fees, like stamp duty on top of that, depending on whether you construct a property or you're buying established, and if you're a first home buyer. So it is a really significant deposit. That's where we've just seen over the last few years, it's been much harder for young people to build up their deposit.
As property prices have gone up. Yeah, especially through COVID. I know Geelong was one of the beneficiaries of property prices going up.
If you're in the market, yes, it was beneficiary. If you're not in the market, then it's just more challenging for you to build up that deposit.
Absolutely. And I think... Am I right? I've listened to a few sort of financial podcasts about this particular topic, Liam, and one of the ones was saying that even though LMI was compulsory for everybody, it very rarely did people default on their loan. So it was very rarely an insurance policy in the overall stats of every home loan in Australia that ever got claimed upon. So it's almost like, the government's taking that risk on your behalf, but there's less risk because people don't really take on a big home loan like that unless they can afford it.
Yeah, absolutely. And the banks are putting these buffers in place to determine that. With the exception of the last 5 years where we've seen interest rates skyrocket, most people couldn't borrow enough to put themselves into a bad position. But when we saw interest rates go up from 2% to 6%, then they really exceeded the bank's measurements on determining what can you actually afford. Because when we submit an application, the bank is adding a 3% buffer on top of the home loan rate that you're applying for. So when the interest rates have gone up 4%, if someone met their borrowing power in their 2% home loan application, there's very good chance that they weren't affording those repayments once they exceeded 5% and got to 6% and above. We saw a lot more of this struggle with those repayments when we got to the higher end of that. Talking on the default, like over 30 years, our business has not seen a lot of people default, probably less than 5. But in the last 2 or 3 years, we've had a lot more people at risk of defaulting or falling into the default with their lender than we had in the previous 25 years of business. Yeah.
Just because of the situation that we've been in. Yeah. So no, it sounds like it's really good. Now, is it only available for new first home buyers?
Yeah.
Is that right? So if you're buying a second home or an investment property, you don't qualify.
If you own any other property, you don't qualify. But there's 3 major categories that people fall into to be eligible for this. So the first home buyer is the first one, and that's what it was set up for initially. Then they introduced it for single parents and guardians. So that makes it a lot easier for the single parent, given that they might have a lot of expenses and a harder time building up a deposit to get into the property market again. So
even though they may have owned property in the past, say in a relationship, now they're a single parent.
Yeah,
they might qualify.
Yeah, they qualify instantly. So long as they don't own any other property right now and they are a single parent or guardian, then they will qualify immediately.
Right.
In their instance, they can actually go up to 98% of the value of the property instead of 95. So again, another misleading thing about the name of the scheme, because in their scenario, it's 2%, not 5%. But then they brought in the last 2 years as well that not just first home buyers who have never owned property, if you haven't owned property in over 10 years now, they are offering the 95% home loan for them as well to help you get back into the property market. Right. And I'm speaking to a number of people who have been in that situation, and it's great because they might not see that with their kids in school, their jobs, whatever their income might be, it's become a lot harder to then build up a significant deposit again. Now they're in a position where if we can just get the 5% together and cover our purchase costs, we don't receive any other first home buyer benefits from the government, but we just get this benefit of entering into the market again with the smaller deposit. People are getting back into the market if it's been over 10 years. Because that's been a real trending scenario for a lot of people that have just said, I've been out of the market for so long, and for me to put myself back into the position just to get into the market is so difficult. These people are in a position
even
where
though they've historically owned a property, if it's been, you said, a 10-year gap.
Yeah, 10 years.
They can get back in.
Yeah, exactly.
I didn't, coming into today's conversation, I didn't know about those other two, the single parents and the 10-year what we call it, amnesty almost, But I think that's great, isn't it? That's an example that the government's saying, well, look, if these people, can get themselves into the property market, it's going to benefit everybody. And also, Liam, as you probably know yourself, coming through buying your first home, if you're paying rent and then you've got to save that deposit, almost once you're in the home, just paying your mortgage, it's easier than it was trying to pay rent and save the deposit. It's actually easier, to come up with that money every week.
Precisely. I've got someone I'm working with that is exactly that scenario where they've just been renting now for over 10 years since they've owned their previous property, and they're just in a position where they can't save that money anymore.
Kids might be in high school, so there's higher expenses and things like that, fees and whatever.
And they can afford their rent. They just can't afford to save up a bigger deposit to help get them in. So they're years away from that, or waiting for their kids to get out of high school, private school as well, where they're no longer paying those big fees. Can they afford the mortgage? Yes, probably, but they just can't get that entry point of the deposit.
Which, as you said earlier, in Geelong market could be over $100,000.
Yep.
So I don't know if anyone listening to this podcast has ever tried to save $100,000 from scratch, but it's pretty tough, no matter who you are and what you're doing. So, no, it's great to hear that actually, Liam, just from someone in the industry. You obviously know what you're talking about, and I suppose clients should have enough confidence to come to you and say, well, look, you guys seem to have the knowledge here of all this stuff changing all the time. Yeah. And as you said, the 5% deposit, or the first iteration of it, came out back in 2020, but it's just changed kind of reasonably recently to be this full 5% deposit scheme.
Yeah, correct. And the thing that people need to know is that not every lender actually uses this 5% deposit scheme. Not every lender's approved. Not even all the big four banks are engaging with this scheme. I can't say that that's by their choice. It might be, but that's where it's really important to use a broker and understand that you might not just walk into an ANZ branch, CommBank branch, and know that you're going to get the best loan, which is the story of a broker altogether. But with this 5% deposit scheme, you don't actually know that they're going to be offering it. And they might just turn around and say, you're not eligible because you don't have the deposit, or this is what your loan would look like. Here's your 6.5% interest rate with the lender's mortgage insurance on top of it. Or maybe not even talk about it, but still wrap it in there.
Yes.
There's a lack of education when it comes to walking directly into the bank, because they can't or won't tell you about what the other banks are offering, or if there's something better for them elsewhere. But with the broker, you can sit in safe hands knowing that whatever my current situation is, at least by talking to a broker, I can put my mould, the piece of the puzzle, into different banks to find out what is actually going to suit me from a policy point of view.
And that's the thing, like a broker's there to be independent. A broker's there to work for you as the lender, as the borrower. So as you say, if you walk into a bank, they're probably thinking about what they're going to make out of the loan before they think about your best interests and what you can afford to do.
Yeah.
So I think correct me if I'm wrong, Liam, but I think we're up over 70 or 80% of loans in Australia now are all done by mortgage brokers.
Yeah, I believe it's at least 75% now.
Yeah.
Yep.
So that's high. So
it is.
If you're sitting here listening to this podcast thinking, oh no, well, my parents have always gone to CommBank and my granddad always went to CommBank and I should just go to CommBank.
Yep. Well,
75% of Australians think the other way. So you're sort of in the minority. So it's worth at least coming and having a chat to a broker.
And it's not to say that your loan won't end up at CommBank either. They might be the best suited lender for you for whether it's an interest rate reason or a policy reason, like we're talking about with schemes and different benefits that are available. But at least you've had someone else, not even yourself, had someone else do the legwork for you to then do all those checks across different lenders to see what is the best for you and helped you to achieve your goal. And ultimately, that's what it's all about, bringing your goal to the broker and seeing how can we actually get from point A to point B. Whereas if you're going to walk into the branch and have that conversation, they'll be strictly limited to how they can get you to point B, or they'll create a different destination that you can meet if they can't help you with that goal.
And I think too, it's important, to mention here too that a broker doesn't cost you any money. So the other thing is, it's sort of like a free hit. Come and see a broker and at least get that professional opinion, because you're not going to pay a fee on top, of what you're doing with your home loan. So it's just a really good lesson, and the knowledge, even myself, who's in this industry, Liam, I didn't know about those two other components of that 5% deposit scheme that you've just spoken about. So, even if you're in the industry, you don't always know unless you speak to a mortgage broker. So it's a good message, mate. Really good message.
The important things with that scheme is that it is very personalised to where you might be buying, because the limitations, the boundaries that are set out by the government in what you can purchase and how much for are going to be different based on where you're located. So you might be in Geelong, where we are right now. That's going to be totally different from Brisbane, Canberra, or take any regional spot of any state. The price thresholds are going to be very different. So it's really important to understand that through your own research, or just letting a broker give you that advice to understand what are the different limitations and parameters I need to work within to help use this scheme.
Yep. So, for all those listeners out there, if you're not listening from the Geelong area, of course, we could be people listening from anywhere in Australia. So, it's really important to know that there are some changes or some bits that change from time to time, or location to location.
Yeah. My biggest thing, what I've seen with many clients, is that they often walk in having their own idea about what they can qualify for. And this is one of the things about the iterations of this over the last nearly 6 years now, how it's changed and the eligibility has changed. We have some people who have already predetermined what they can achieve because they've had a conversation with a broker or bank before about what that looked like.
It could have been 3 years ago.
Yeah,
so
precisely. Or their own research, but maybe that's not the same as today. And so if you're interested in getting into the market, then now's another opportunity where you have that conversation with the broker or a bank again to see how have these parameters changed and does that affect my situation? Maybe before I was only able to go to 800,000 and now you can go to 950,000, which could have been your goal. It's just understanding where do we sit now that this keeps evolving.
Yeah, and it's so important to just get someone who's got their finger on the pulse, to look at it for you. Because I've been guilty of this. You Google up something, Liam, and you click on an article because that says government deposit scheme, and then you click on it, but it's a 3-year-old article. So just because it's the first response on Google doesn't mean that it's relevant or it's recent or it's even legal now. So some of these articles are written by whichever website. We're probably one of them that wrote about it back then. It doesn't mean that it is relevant and current. So the idea is to get that professional opinion.
Yep, exactly.
Thanks, Liam. That's great. Yeah, so that's the Australian Government 5% deposit scheme. So as we mentioned, there's some bits and pieces around it. So come and see a mortgage broker when you can. Liam, the second one we wanted to talk to about today was the Help to Buy scheme. So this is a second scheme that, correct me if I'm wrong, it used to be a state government, Victorian state government, but has now gone to federal. Is that right?
Yeah, correct.
Can you run us through what that is?
Yeah, so the Help to Buy is effectively where the government has decided they'll help chip in some money for you and literally putting in money into your purchase. You would then borrow the remaining funds that you need for your purchase price. Therefore, if you're borrowing less, you might have smaller repayments. And the government, whatever percentage they put in, they're going to own that percentage of the property. So for someone who might say they've got this objective of buying for $650,000, but in their own rights, they couldn't actually borrow enough money to get there, they're still going to have to come up with a good deposit to start with. In this example, 5% is going to be a good point. But maybe under this 5% deposit scheme, if you're buying for $650 and you needed to borrow over $600,000 and you didn't qualify, perhaps you qualified to borrow $500,000, you could use this Help to Buy scheme where the government's going to put in some money for you. You own the remaining share of the property. If the government puts in 25%, they own 25% of that property.
So long term, that's even after capital growth happens in 5 or 10 years' time, they're always going to own that percentage, not the amount of money they put in. They're going to own the percentage of their home's value as it grows.
Correct. Yeah, exactly. So as we see people value, equity increase in the property, the government's equal share of that will increase as well. But it'll go both ways, that if it went down in value, then the government share is going to go down as well.
Yep, sure. And Liam, have you had much experience with the Help to Buy scheme? Is it a hard one? Is there a lot of factors that boxes you need to check to become eligible for it?
Yeah, for this one, it's probably a little more loose than the 5% deposit scheme in terms of eligibility. Almost anyone can qualify for this version.
Right.
It's got some different limitations in the lenders that will act in it. So as opposed to the 5% deposit scheme, which has a broad number of lenders, a long list that can use it, there's really only 3 lenders that can help you with the Help to Buy scheme now. So far more limited avenues that you can go down.
Sorry to put you on the spot, but does that mean you pay a higher rate or not, or necessarily, or not really?
They're very competitive lenders. We've seen that they are still competitive interest rates. In my conversations with clients, when I've talked about the difference between these two different schemes, people naturally want to go for the 5% deposit scheme and own 100% of the value of the property and let the government be a guarantor for them.
Yes.
In this scenario, I think it's still helpful and it's worthwhile for a lot of people to consider doing it. The main difference being that it can either keep their repayments much lower or they can enter in at a higher price point that they personally couldn't achieve by themselves. But in terms of the lenders that we can then go to, it does mean that we're strictly keeping our policies that you might qualify for to these 3 different lenders. And if you've just got something unique about your situation that doesn't fit into any one of their boxes, you might not be able to use the scheme at all.
And I suppose that's where we come to a mortgage broker, because you'll know what those things are inherently, because you're looking into it all the time with other clients.
Yep.
We don't have to get into the real nitty gritty and the check boxes, Lam, but I understand. I mean, if I was the government and I was chipping in 25% of your house, I'd want to make sure it's kept in good condition.
Yep.
So are things like inspections going to happen down the track like a rental property, or how does that work? How does the government keep an eye on their investment with you?
Not that I've been made aware of with that one. But I do know that if you want to make any changes to the property, you need to get the government's approval to do it.
So, big, like, are you talking extensions or whatever, or renovate the bathroom?
Definitely extensions, but renovating of the bathroom, anything that usually would require some permits is going to need to be signed off by the government, because they technically own the property with you.
Yep.
To what extent they go to, I'm not entirely sure on that.
It is reasonably new.
I believe there's an application process you need to go through with the government so that you can get approved to make any changes to the property.
So straight away, I'm trying to think of psychologically what some clients will enjoy, the idea that, look, I'll get the government's help, but I want to own my house. I don't want anyone else owning part of my house.
Yeah.
But then there's going to be a component of some people that go, if I own 75% of this property and it goes up in value over 20 years, whatever.
Yeah.
Someone else owns 25%. I get to live here. I get to enjoy it. I get to renovate it. I get to bring my kids up here. And you're paying a lot less repayments because you're only really lending that 75%.
Yeah, precisely.
Yeah.
One of the big things that I've spoken to people who have really defaulted then to the category of going to the Help to Buy scheme is that it really can change the asset class that you might be buying into. Yeah. So going from what you could afford, maybe a unit or a small townhouse, could really change to a fully detached house in what you're buying, which might be more suitable for you as a family, changing the number of bedrooms that could be under the roof.
Yes.
That's a real practical need that needs to be met for a lot of people.
And even, Liam, I can imagine which suburb, because if you have for schooling and things like that, like public schooling, if you want to get into a zone, that particular suburb might be a bit more expensive.
Yep.
So maybe you owning 75% of that house is actually a really good thing because the school that your 3 kids go to, where you need your 3 or 4 bedroom house, is big and important to you. So that might be more important to you than owning 100% of your own property.
Absolutely. And if it meant the difference between buying for, say, 500,000 to maybe 700,000, you'd put the numbers wherever you'd like. If it meant that you were not buying a different type of asset, and it was the apartment situation, and apartments historically aren't great when it comes to capital growth.
They're probably going to grow slower over a period of time. Well, they have, proven that than a detached home.
Yeah, if you assign just some yearly growth to these, not using any data here, but if you said that $500,000 apartment would grow in value at 4%, but the $700,000 fully detached house might grow at 6%, if you're still owning 500 grand of the $700,000 house, year on year, you technically will be making more money off the capital growth of the better asset. Even though the government's making money off it as well, it may be meeting a practical need. It might actually financially work out better for you to be in that more valuable asset. And over time, you're still being rewarded, even though the government has owned a portion of it.
It's funny, Liam, if anyone's out there in business, you've done it recently, you've joined our business. So sometimes when you own part of a business, it's the same thing. You think, I'm better off to own part of something that'll be bigger in the future, or own 100% of this small thing over here. So anyone that's listening in business, it's probably the same scenario where you say, well, am I better off owning 100% of this size or 75% of that size? So you actually could be better off the other way.
And good for listeners to know in terms of getting out of this scheme as well, it's not just when you sell the property and therefore the government's going to take their portion of the sale proceeds. You can also buy back that from the government when you're in a position to do so, whether you're building up money or because you've paid down your debt, building some equity in the property, borrowing against that equity. You can repay in portion or in whole the government in pieces.
That's great news, because potentially over the next 30 years that you're living in that property, bringing up your family, doing all that, you could be chipping away. If they own 30% at the start, you could be chipping away at 5% here or 10% there, and at the end you own it anyway.
The most important thing, I've had a client do it in portions, maybe 5 different stages where he's bought back and then owned 100% of the property. It is still based on the time that you do want to make your next application to buy back from the government. They will revalue the property. So we're still working off the percentage. If it's gone up in value, maybe your attempt is to buy back another 5% of the share of the property. It'll be 5% of today's value, not the value of when you purchased it.
Not back when you purchased it, Well, that makes sense. I think anyone that would think that government is going to just give money away, like they're going to want to get their investment back just like anybody else would. In a way, is it a bit like, is it parallel to like the bank of mum and dad? Some people say, well, look, mum and dad are going to own 25% of my house because they're. But is it a bit like that? But you're doing it with the government, which is possibly a bit more secure, less family sort of
course
stuff going on.
I suppose it comes from the preferences of those parties involved and how much control they might have. So if mum and dad are involved and they don't really mind and there's not much control over it, then that can be a good way compared to the government's control if they do decide to insert themselves on anything. But it is very much the same in terms of the practical nature of the numbers, that if you're going to start paying back mum and dad or buy it back off of them, you'd still follow the same process.
Now, we're not going to get into whether you should have your father-in-law over on a Sunday to tell him what you're going to do to the bathroom. We don't want to go there because that could get hairy for a lot of people. So thanks, Liam. Was there anything else about the Help to Buy scheme you think we should bring up with listeners today?
Well, in terms of how it's different from the 5% deposit scheme, I think the big things are that with the federal government iteration of this, so it was at the state level before, what the federal government's willing to do is put in 30% for your established properties, and if you're going to construct or buy a brand new property, they're willing to put in 40%. So you then need to meet, if you're putting in 5% to start with as well, the remaining 65% of the property price for an established property, or the remaining 55% as a loan for a brand new build.
It's important too, isn't it? Because you've got to think, I'm only going to be paying back my percentage too. So from an affordability point of view, I think that's a really important one, because you could be buying in a whole different suburb with a whole different kind of property that you thought you'd never be able to afford. You get to live in that and enjoy it for the next 10 or 20 years. and possibly pay it back over time. So it's actually not a bad scheme, yeah.
No, not at all. I've got a client where I've run through a number of different scenarios between both of these schemes, and he really likes the idea of the Help to Buy scheme. He's a single gentleman earning a good income, also has a very healthy deposit, but he knows it's the difference between him buying for $650,000 and $800,000.
Yep.
And down here, it can change the location that he's buying and would really like to buy into Newtown rather than Belmont. As an example.
Yeah, so just different suburbs are always going to be priced differently because of location to public transport or the city or whatever.
Yep.
I think everyone listening to this in any city that they live in or town they live in Australia, even a country town, the main street might be more expensive than the street four blocks over. So that's exactly how it works. We don't have to get into this too much, Lam, but tax-wise, capital gains tax, obviously the government's not going to pay their own themselves capital gains tax, but I assume that if you do sell in the future and you pay your portion of the capital gains tax, is that how it works? Or
well, as both of these schemes are designed to only be for principal place of residence, there should be no capital gains tax attached to it.
Yep. I'm actually glad I brought that up because I sort of half forgot about that. So capital gains tax, of course, is not paid on your primary place of residence. So,
and that's an interesting point just to touch on, because a lot of people, particularly young people, if they are in a good financial position or they're just thinking about the future, all things that we love to talk to them about, sometimes they want to turn the first home into an investment property. And that's really important under both of these schemes, that they are designed to just be for your home. Yep. And so long as you're using these schemes as your home, you can't be turning them into an investment property. At that point, you need to turn around to the government and figure out whether or not you are still a part of that scheme at the time that you want to make it an investment. I'd say it must be much harder under the Help to Buy scheme because we're talking about the government owning a portion of the property. But under the 5% deposit scheme, you can't just walk out one day and go, I'm going to rent it out and go live back at home or go rent somewhere. They will pick up that it is being rented out and say, this is no longer for your home. You now need to determine if you're eligible for a standard investment loan, which if you didn't use the 5% deposit scheme, they don't care about that. That's not a problem for them. But under this, they'll put you on a default interest rate and ask the bank to contact you for applying for an investment loan. Right. And we have seen that happen over the last 5 years with this version of of help from the government.
Yeah, because some things are like pretty cut and dry, aren't they? They're like, I'm gonna work and live in this house for the next 30 years, right? But as we all know, you get 5 years in and you think, actually, I've got an inheritance from grandma or something like that. Oh, actually, we want to move to Queensland or something. So then all of a sudden you're like, actually, we want to move, and make an investment property. So there's any time you're getting any of the help from these two schemes, I suppose, you need to be aware of what could happen in the future. Yeah. And that's the role of a mortgage broker, isn't it? That you're giving good advice to people in that area. So
exactly.
Well, thanks very much, Liam, for today's episode. I think talking about the Australian government 5% deposit scheme and the Help to Buy scheme is really important for a lot of first home buyers. And I really thank you for your time and welcome to the M Group ownership group.
Thank you.
Well done.
My pleasure.
You've been listening to the FS360 podcast. Financial Security 360 is at the centre of what we do. If you'd like to speak to one of our professionals about a range of individual and business needs, give us a call.